Good afternoon, everyone. In today's video, I'd like to talk about both stocks and futures volatility box trade setups for today, September 2nd, 2020. Now, today in the morning, really that first hour test is where we had our first hint that the Nasdaq was the market that was experiencing the most volatility. If I actually start by having a discussion there first, if we come into the Nasdaq and we load in our most conservative models, which is our Doomsday Conservative models, you'll notice that the Nasdaq broke outside of even that. And so if we contrast this with something like, say, the S&P, just in that first hour test before looking at the rest of the day's activity, the S&P, if we look on the scalper models, you'll see we're still contained inside of price action until that subsequent hour. If we look at the Dow in that same first hour, you'll notice same exact thing, right? The Dow was also contained inside of the scalper volatility box models. However, if we came into the Nasdaq, this should stand out where in that first hour, which is 6 to 7 a.m. Pacific, we really fell even outside of those clouds, obviously, but even outside of the Doomsday Conservative clouds. And so that right here was your first hint that you were experiencing much greater volatility in the Nasdaq market compared to the S&P and the Dow, and this volatility in the Nasdaq was also creeping into the S&P futures. Now, if we tie that back into stocks, that led to a huge burst of stocks really triggering right around that same time, which is the edge of the hour between 6:55 and 7 o'clock, right around there, with most stocks then hitting their target by 7:02. That was sort of that one point today where we had a good amount of trades that set up. And to give you perspective, by the way, at least with our stock volatility box tool, we had a grand total of 167 trades in just that 6 to 10 a.m. Pacific hour. And these are trades that still gave you 3 minutes or longer to enter the trade. If you start to account for the trades which really were more like wicks that essentially hit our entry, then went off to go hit the target right away in that same reversal period, that number starts to increase dramatically more. So now if I come in back to something like TQQ, TQQ also gives you an example of how you could use the daily volatility box levels, especially when our hourly ones are telling us that we have more volatility than usual. So for example, in TQQ, we had price action breach our volatility box edge. This is the aggressive volatility box, really chopped around sideways here, and then we went and we hit the target almost right away. Now we're still looking for this edge signal confirmation, but what I really want to sort of point out here is this notion of the hourly and the daily models almost working together and using the two to get really a complete picture, right? The hourly models gave you the hint that the Nasdaq was facing more volatility than usual, and we broke outside of all of our hourly volatility levels. Nothing there really contained price action. But now if you come into the daily here, you'll notice that the daily really did a good job of containing this price action. And if I load in the conservative models as well, then you'll notice that in that second breach, really after we had this bounce right here, our first bounce hit the target, had our second retest, right? A common theme that we've now talked about, the first, the second, but the third one usually tends to break. We saw that happen one more time. Actually, we ended up hitting the target, but we ultimately, I would consider this a longer term break, where we then fell into our conservative models, chopped around sideways here, even went outside of these clouds before we got the edge signal confirmation. But then if I zoom out from this point, you'll notice how that did a much better job of really giving you a reversal point. Unfortunately, we did go outside of the clouds here, which was sort of the story of the model, especially even with our hourly models. We'll talk about that in just a second. But now if we switch gears then, take a look at the converse short via our conservative models, you'll notice that even the short ended up working, right? You knew exactly from this pivot point where price action was essentially expected to go to, which is right around the conservative clouds here. If I hide the aggressive here, that should paint this picture a little bit clearer, where we went into our conservative model clouds here. That's where price action really stopped, reversed, hit that target line after getting the two edge signals right here, actually three grand total, but then we still continued to chop right back into the clouds and even above, suggesting that really there was a good amount of buying action or buying pressure that came in to support this price action after this original dip. We don't see this happen too often, especially via our conservative models, where we, on a market like the Nasdaq, where we have price action breach our lower end of the volatility box via the conservative volatility box, and then rip right back higher to breach the upper end of the volatility box, and on both sides going outside of the clouds. So I thought that was fairly interesting. If I show you how this translated to some tech stocks as well, we'll come to a chart of Roku, we'll load back in both our aggressive and our conservative volatility box models. You'll notice one more time that price action fell into our aggressive clouds, chopped around, and then reversed from this point. And this was again in that 657 to 702 period, right? The theme that we've been talking about, where really price action in a lot of tech stocks, that's where we had the price action fall and then the reversal for the day. We look at a stock like Fastly. Fastly came just slightly outside of the clouds, and then we had the edge signal really on the move back up. Then again, we had one more retest, right? So this was one. This is the second retest. Even from that retest, two edge signals bounced from there. And if I give you the full picture, you'll see that from our actual clouds here for the rest of the day, Fastly ended up jumping 2%, right? 5.2%, I think it was in grand total. And then if I switch over to a stock like Datadog, very similar pattern as well, except in Datadog, we saw price action fell even outside of the clouds, which we saw fairly consistently today. There was a good amount of selling pressure in the morning here, where we bounced into our clouds, had the edge signal, hit the target, had that second retest, fell a little bit deeper in Datadog before still having that ultimate reversal. And this is where, for those of you that use options, something where you're a little bit more flexible with your stop versus those of us that use something like stock. And that's where, if you use something like options, you have a little bit more flexibility to deal with this kind of an outbreak outside of our clouds versus if you use something like stock where you have a much more defined, harder stop. That's where something like this picks you off. Now, of course, this was a second retest, so not a valid trade, but it's this general idea of stock versus options. Now, if we come back in and we go back to our S&P chart here, let's go ahead and start by taking a look at some of our futures volatility box trades for today. So if I start by loading in our scalper volatility box model on the S&P, and we'll spend a little bit more time on the S&P and then just fast forward through the rest of the charts here. In our scalper models, in that first hour, we were still contained. In the next hour, we saw a good amount of volatility enter the market where we went outside of our clouds right here. That then took us to the aggressive volatility box models. And off of the aggressive volatility box models, we had a breach, we had an edge signal arrow, and then we had an opportunity to enter at the cyan lines or better. And this was that first trade in the S&P. This was a winner in which we made the move that we were looking for. However, it only hit the first target, right, in this move, because after we hit our first target right here, we then move our stop from outside of the clouds to break even. And that's where, in this slight move up, that's where the break even stop was taken out before we had really a nicer longer term move. Again, cue that same conversation of options versus futures, where options just gives you a little bit more flexibility in managing some of these, versus with futures, the losses can really add up. So bringing a break even stop is a hard actual stop in which the order gets taken out as soon as price action hits the cyan line, versus with options, you have just a tad bit more flexibility there. Now, moving forward in the S&P, we again had price action fall into our volatility box clouds right here, this time waiting for an edge signal, which came a little bit later, and so we didn't have an opportunity to enter at the cyan line or better, and that's where really from that point onwards, we saw a fairly nice reversal in the S&P. Now, if we fast forward to the next hour, this is the 9 to 10 a.m. Pacific hour, this is where we had volatility really start to go outside of even the aggressive models. We had price action breach our cyan line, we had multiple edge signals here, which really should have given you all the confidence that, hey, I expected price action here to start to reverse just a tad bit, especially given how the market had been acting till this point. However, if we start to zoom out here, you'll notice that price action then we had a really strong move up here, and really after that buying pressure ended up going outside of the volatility box clouds on the aggressive, which then took us to our doomsday aggressive models, and then via our doomsday aggressive models, if I zoom out, that was really the rest of the day in the S&P futures. Now, if I contrast this with the Nasdaq just one more time to give you an idea of what that morning looked like, you should see in the morning we fell outside of our volatility box clouds before the day even started, where at this point right here when we breach outside of the clouds, this is when we realize that, hey, the Nasdaq is not a market that we're looking at trading for any part of today. Now, if we switch over to a chart of the Dow futures here, we'll repeat the same process just like we did in the S&P. The Dow here towards the edge of the hour got fairly close to the cyan line, but didn't quite breach it. And so at that point, we still had the confidence that, hey, the scalper is still containing price action until the next hour came where, similar to the S&P, we broke outside of the clouds here. That then took us from our scalper to our aggressive models. Once we go to the aggressive models here, we breached our cyan line, waiting for the edge signal, got the edge signal, didn't quite get an exact opportunity at the cyan line in this move up, but we got fairly close. For those of you that, again, trade options, this was the opportunity to re-enter. For those of us that trade futures only with the futures volatility box, didn't quite get enough to the point of entry where the order is actually sitting, but we still saw a fairly nice reversal, again, giving you more confidence in the aggressive models on the Dow, whereas in the market like, say, the Nasdaq, we didn't really have any sort of edge, right? Now I keep zooming out here and we take a look to see what happened into the rest of the day. Into the close here, that's where the Dow again breached our cyan lines. Now this came really towards the edge of not only the hour, but also the edge of the day. That's where really the idea of taking on new trades isn't all that appealing. If you did take it, you still hit your target. And so that was a fairly nice trade on the Dow, but towards the edge of the day, that's not really a point in which I'm looking to initiate a new position. Now switching over to the Russell here, coming right back to the beginning, Let's start by, again, loading in. This time we'll just start off the aggressive. We broke outside of the scalper. Even off of the aggressive, you'll notice we fell outside of our clouds. And at this point right here, once we go outside of the clouds in that first hour test, that's our sign to then switch over to our Doomsday aggressive models. Now, looking at the Doomsday aggressive models, you'll notice that this did a much better job of containing price action. So if I zoom out just a tad bit more, you'll see that the breach in the cyan lines here on the Doomsday aggressive models in the Russell ended up becoming really the absolute best point for the day that you could have bought. This is something that we're trying to still figure out, is how to use that first hour test to find some of these pivotal points. For those of you that have been looking at the futures volatility box, you'll notice that this happens fairly often, where when we're still looking to try and identify the models, oftentimes there you'll have some fairly nice breaches, which lead to almost the greatest reversal point for the day, right? If we take a look at this, and if we are able to find a setup in which we can participate here, that ends up giving you a 1.79% trade in the Russell off of the right models. But that's where the trick starts to come in, is when do you decide that these are the right models? Now, of course, the best trick here so far that we have is the edge signal. I know a few of you also use something like the V-score, where if you load that in, the V-score, using that in terms of standard deviation to see whether or not we have any kind of extreme standard deviation, starts to give you some sort of notion there. That's something else that we're looking at as well, to try and see if there's some other signal there that could either append to the edge signal here to try and give us some more ideas, or maybe it gives us more accurate signals in that beginning hour. So that's something to look out for, but really for the Russell, no other trades there. Now, if we switch gears and move on to a chart of crude, crude was a bit more volatile today. So we'll start with our aggressive volatility box here. Very similar. We'll look at the first hour test. Now in crude, we did breach the cyan line. It was just a wick, but we still breached it in that first hour test. And so at this point, we're checking to see what happens first. Do we go outside of our volatility box clouds right here? Or do we see the buyers driving in, at least price action the same amount on the opposite side, which gives us some sort of inclination that, hey, these models are being respected and the buyers have some sort of control in the crude market. Now, in the case of crude, we saw that the buyers did drive up price action before we went outside. We were looking at 42.20. We got real close here. I think this was off by one tick. I think we are at 42.21 if I take a look at the low of this candle. Yep, 42.21 before we still had a rip up higher. And so at this point, you may argue that you're really close enough where, again, we talk about this idea of if you have to squint, it's better to just switch models. In this case, the definitive price target that we were looking at was 42.20. That wasn't breached. Instead, we saw price action rally to what was our first bare minimum target of this move that we were looking at in this rally right here, which is what gave us the confidence to continue to use the aggressive models. Now, however, in that next hour, you'll see that price action really went a little bit more wonky here, right? We had price action breach outside of our clouds here. That then took us from our aggressive to our Doomsday aggressive models. And using the Doomsday aggressive models, we had price action breach, we had an edge signal, and we had an opportunity for a re-entry at the cyan line or better. And this right here was the fill in crude. However, in crude now, if I use the arrow tool here to draw this out to give you an idea of what actually ended up happening, crude just really continued to keep selling off a tad bit lower here. We ended up going down outside of our volatility box clouds. Once that happened, if I switch over to even something like, say, the Doomsday Conservative models, actually we'll go conservative, we'll just go in order. Via our conservative models, we ended up breaching outside of those clouds as well, which then took us to our Doomsday Conservative models, where if I zoom out here, for the rest of the day, we didn't really have any other breach via our Doomsday Conservative model. So that was a trade in crude, which was a stop. And if I switch gears to natural gas was a much better sort of market to trade today. Now, if we take a look via the aggressive models in natural gas here, we really had what came close to being a breach here. And even if that was a breach, still ended up making that move. And that continued to give us the confidence to use the aggressive volatility box models until in the next hour, we had price action really tell us otherwise, right? So after that point, we had our likely trending up bubble. That then took us from our aggressive to our Doomsday aggressive. We didn't get any sort of edge signal. Still went outside of the clouds before we got the edge signal. Keep coming down to the conservative, same exact thing, which finally took us to our Doomsday Conservative models, which are our most conservative models that we have. Really, if price action doesn't stay contained inside of this, that's then our sign to sit outside on the sidelines. However, with our Doomsday Conservative models, we had price action breach, we had an edge signal, and that then gave us an opportunity to enter at the cyan line or better. In fact, we had better opportunities to enter than the cyan line. We got our first minimum target here. The second contract where the stop was moved to break even got taken off as break even. And so that was the first trade in natural gas, which was a winner. Now we're still looking for more breaches. At this point, we have confidence, right? Our models are being respected in natural gas. Still looking for more breaches. We had our next breach happen when price action breached our cyan line here. Again, got the edge signal arrow. Again, got an opportunity to enter at the cyan line or better. And really at this point is where we got our fill. And in the second trade in natural gas, that's where we ended up hitting not only our first, but also our second target, which is this gray dash line right here. And the second trade in natural gas was about the best trade that we had for today. Now, with that trade, we ended up breaching our cyan lines right here. And we were waiting to see if we would get that same opposite and equal reaction. This was towards the edge of the hour, so this is free information. We did not get that, right? In fact, price action then continued to break down lower. And at that point, that was our sign to stop trading natural gas. We got two nice winners out of natural gas, and that was it. After that, we're now focusing elsewhere on different markets. The last market that I'll talk about in today's video is gold. And if I again repeat the same process in gold here, we'll start by using our aggressive volatility box. Using the first hour, we breached both side cyan lines, but we also saw follow through, which gave us again confidence that the models in gold were being respected. We had the trade set up in the 6 to 7 a.m. Pacific hour, where we had price action breach. We got the edge signal. We had plenty of opportunity to enter at the cyan line or better. And really at this point, I thought we had a fairly nice shot at gold starting to have a really nice rip up higher from this point. And instead, we actually just ended up chopping around sideways here to lower and then tried to make a nice move up. That failed really at the cyan line or better for those of you that were looking to try and get out. And that then gave us a stop out as we went outside of our volatility box. Now, this is a pattern that another member had actually mentioned. I just want to call this out for those of you that are looking to try and be a little bit more protective of your trades. That's where using the squeeze signal here, we had multiple squeeze signals. Now, usually with our squeeze signal, this to us would indicate a bearish move. This isn't all that exciting considering that we have a bearish trade in our volatility box zones. So using context, this isn't a trade that we're necessarily looking at from a squeeze standpoint. However, for those of you that are looking to be a bit more cautious, this could then be your sign really whenever you see either bearish edge signal arrows where you're typically looking to go long, or bullish edge signal arrows, or squeeze signals, excuse me, when you're looking to get short. That's where if you are looking to try and find opportunities or reasons to get out of the trade, almost hit the eject button, either at break even or whatever minimal loss you may be at. That's the only one sign that we've seen so far. Which, if you are going to add this to your trade plan, the one thing that I kind of caution you is if you're going to add it to your trade plan, make sure it's consistent. Make sure it's something you do every single time as opposed to just something you do on a whim. Where if you say added in this notion that, hey, if I'm looking to get long and I see bearish squeeze signal arrows, then I'm going to move my target instead of being at T1 to break even and really try and see if you have an opportunity to get out without really dealing with the loss. Keep in mind that that does come with the trade-off of, is say in this case, instead of chopping around sideways and falling lower, if we had gold rip up much higher, then you'd be sitting on the sidelines instead of being able to participate. However, it's really then using technical indicators as well as a process-driven approach to try and either take trades off at break even, protect your trades, or really just accept the risk when you take the trade on that, hey, I'd like to see what happens. Do we get a move outside of the clouds first, or do we get a move to our first target first? And if that risk is too large for you to manage, you can even use something like the micro gold where you can layer that on based off of something that makes sense for your account size. All right, so hopefully this video gave you an idea of not only the stock trades for today, but also the future trades for today, and how to use both the hourly and the daily levels in congruence, really, especially with things like the futures markets, things like the Nasdaq, and then finding the heavyweights inside of the Nasdaq when we know that, hey, there's more volatility here, or if you're looking again to try and play fade moves, then that's where you knew that right off the bat today, the Dow is the one that's facing less volatility. So if you get an opportunity to participate in fades in the Dow, those probably have a better shot of giving you that ultimate reaction. Is really just moving, price actions moving with the rest of the market, and the Dow has a better chance of staying contained inside of our clouds given that it's still on, say, the scalper models. All right, hope this video helps. Good luck trading the rest of this week, and we'll see you in the next update. Take care, everyone.